Okay, hello everyone. This is Prime US REIT third quarter 2023 key business and key operational updates dated 7 November 2023. Right, this REIT has 14 Class A freehold US offices. Right, so these are their offices in the US. As I understand, California seems to not be doing very well. So maybe these two are not doing very well. These three. There's a third one in California. I think the San Francisco area is particularly not doing so well, but we'll see. Right, the rest I have to say I'm not very familiar because I do not live in the US. Right, so that's the downside of not investing in a country that you do not stay in. You're not so familiar with the ground sentiment. Right, so they admit that there's cyclical headwinds in high interest rate environment. So headwinds is clearly not a good thing. Right, they expect improvement in the office environment in 2024. Right, they say there's a momentum to return to office. Right, last year I think in 2022 I visited JP Morgan in Singapore, and they were saying that they felt like work from home was a very effective policy, but I found it hard to believe then and I do believe that people are now finding that it is clear that coming back to office has its benefits, and both in Singapore and the US I think there's a trend towards returning to office, but more so in Singapore than in the US. The US I think is a bit slow in this regard, but it appears that it is taking some, it's drawing some momentum. That means they are getting there. Right, so people are returning to offices. Right, so there are new space requirements in secondary markets. Okay, there's slowing construction and record conversion. So that means the record conversion is talking about the fact that because of the excess office space, some office is being converted to other asset classes like living quarters. Although this has, I think, been plagued by difficulties because the infrastructure for an office is quite different from a living space. Right, so the conversion is expensive and might not be absolutely successful. Right, I think I won't go through everything because there's a lot of stuff here. I'll just go through the key things. There are leasing discussions with the some of the assets, as well as I think balance sheet is the big worry. Okay, they say they have a buffer of 12.9% to 50% leverage threshold. Right, so the leverage currently is 43.7%, pretty high. Debt headroom is only 203 million. Interest coverage ratio is not too bad, 3.2%. Right, and they hedge 78% of it, and most of it is hedged to 2026 and beyond. But I think the worry is the 2024 debt maturities, as you will see later. Right, so we look at financial updates. If we look at quarter-on-quarter distribution, why they have dropped by 23.4%, there are three reasons. Right, the first reason is because manager has elected to receive his fee in cash. Right, so if they receive in units, the problem is number one, dilution, right, and number two, when they sell the units for money, for example, it will cause further pressure downwards on the stock. The stock price is already very depressed. Right, so giving out in units is not a good thing. They might as well give it out in cash. I think this is the correct approach. Right, so if we adjust for the fact that the management received in cash, the drop is only 16%, and the 16% basically they are saying there are two main reasons. One is higher interest rates, which cost $1.6 million more, and also the absence of a one-off distribution. Right, so that's the reason for the drop in distributable income. Right, so the debt, I think as we mentioned earlier, we are a little bit worried at 43.7%, although interest coverage ratio is not terrible, 3.2%. So let's have a look at this. I think this is the most important thing. I think this is the main worry, that next year in 2024, they have to refinance this $400 million. Alright, they say here 330 is interest hedge until June 2026. But I think the main worry is whether or not the bank wants to refinance them. Right, so I mean, it's good that if they refinance at a low rate, I suppose, because they already hedged it at a low rate. But whether or not this 330 million is actually renewed or not in July next year is an issue. And I think end of this year they are also going to have a look at the valuation of their properties. So they are going to revalue their properties, and there is another point of concern. It may increase their aggregate leverage, because leverage is about how much debt they have, which is at this point fixed, divided by their asset valuation, right? So if asset valuation drops, this percentage is going to go up, and that may be a problem. If it goes up beyond the capacity, right, I'm not sure if they can refinance this amount. So that's a big concern at the end of the year. Yeah, not going to go through too much of this. I know they hedge a lot of their interest rates, which is a good thing, right? So we can have a look at maybe the areas and how they are doing generally. Right, occupancy is quite high in some cities, 98.9%, 100% here, right? Some of them are, some places are doing pretty well, right? So we'll have a look at this, right? Yeah, so you can see the San Francisco Bay Area is quite bad, right? Yeah, so I don't think there's too much to say. Right here they say that some places they have potential positive rental revisions that are possible. For example here, right, this is what they are charging their tenants, this is what the area is asking for, so there's a 20% upside, right? So in some places like here also, but I'm a bit questionable about this because the occupancy is so low. So I think there's a demand issue here, right? So yeah, I think most of their tenants are pretty big companies, so I'm not afraid of them going bankrupt. Yeah, so the main issue and worry about this REIT is basically the revaluation of their assets at the end of the year, and also their refinancing next year. There's quite a lot to be refinanced next year. Right, so with that, I think I won't carry on with the presentation, right? I would like to advise that this REIT is highly speculative in my opinion. There is a possibility that you'll get in trouble, right? So please do your due diligence before you do any investments. Thank you.